South Africa signed a major multi-billion rand loan agreement with the World Bank to help fix crumbling infrastructure and boost our country's low-growth, high unemployment economy. And the funding is expected to target key reforms in energy, freight transport, and the green transition. But it also adds to South Africa's growing debt burden. To unpack the risks, the realities, and the potential impact of the deal, we're joined by economist Dr. Azar Jammine from Econometrix. Azar, Dr. Jammine, good morning. Thank you for your time. $1.5 billion, 27 billion rand. It is a significant injection. But is this loan a lifeline for South Africa's economy or a plaster over a deeper structural wound?
I would say it's more of the latter. The fact is that the country is struggling to pay its way at the moment, and public debt has been rising for the last 15 years from 22% of GDP to levels around 75-76% of GDP at present. And as a consequence, interest payments on what government borrows have soared from 7% to 22% of government revenue. In other words, more than 1 in every 5 rand that is collected in tax is then paid back to those financial institutions who have lent us the money to enable us to pay our way. And that is unsustainable. But this is a fairly logical and commendable measure, partly because loans from financial institutions such as the World Bank and other multilateral institutions usually come much more cheaply than the loans that are raised by the government through their weekly auctions, which are bought up by your private sector financial institutions, your asset managers such as Coronation, 91, Old Mutual, Stanlib, who demand a much higher rate of interest to cover themselves for the risk. To give you an example, this loan has been set at the daily overnight lending rate of 7.1% roughly, plus 1.49%. That is, in other words, the interest payable is about 8.6% over 16 years, when we have a situation where on the ordinary market, the rate of interest on South African government debt of 16 years duration is over 11%.
Wow.
So we are saving more than 2.5% interest paid every year for the next 16 years by having this form of debt rather than borrowing from as I said, the private sector financial institutions.
I mean, again, and if there's time, maybe we can come back to this idea of really credibly getting the economy to grow so we're not placed in a situation where we have to borrow money. In other words, we can sustain our bottom line and our budget. I know that that's complex. Let's see if we have time. I want to go back to the terms. You talked about the difference in the interest that you'd get from some of the alternative lending institutions. This loan does carry favorable terms, as you've outlined, a 16-year maturity rate, low interest. But with the debt service cost that you've just reminded us about already nearing, $500 billion annually, is it not adding unsustainable pressure to the country's already heavy fiscal burden?
Of course, it's adding to our fiscal burden. But the point is that if we didn't get this money from the World Bank, we would have to go to the market and raise it at a more expensive rate. So it's not as if let's borrow some more money and play around with it. It's necessary to find sources of finance that are cheaper than are available otherwise. The other thing to bear in mind is that there's been a lot of criticism even by the Reserve Bank that the Treasury has been tending to try and borrow shorter term from the market because the rates of interest at the shorter term end, 2 or 3 or 5 year money is much cheaper at rates of interest of 8-9% as opposed to the 11% plus for borrowing 16-year money. And here's an opportunity to pay the same interest rate, but to borrow the money for a much longer period of time.
Yeah.
And so, the danger with borrowing too much short-term debt is that suddenly you know, in a year or two's time, the government will be obliged to have to repay that, and it may not be that easy to do so in such a short period of time.
All right, let's talk about what it's for. Energy security, freight transport reform was among the key pillars of the loan. In your estimation, has our government shown enough capacity and political will to implement deep structural changes to deliver meaningful results?
The answer to that is yes and no in the past couple of years. Certainly not a few years ago, but since Operation Vulindlela has been in place, there have been attempts at actually getting to grips with these structural reforms. Some have been more successful than others. Certainly in the energy sphere, we no longer have load shedding of any material proportions, and that suggests that there has been some improvement. But the real problem has been in the area of transport and logistics. Our ports, our rail network have not improved. They've been going downhill for the last 6-7 years. And there have been marginal signs, if I look at the graphs, of some improvement most recently, but that is where we need to focus. So you're quite right to raise that question. The advantage of getting a World Bank loan as opposed to borrowing the money from the markets here is that the World Bank will ensure that the money that it has lent to South Africa is being used for the purposes intended, which is not always the case with the money that government borrows.
Yeah.
And we've seen over the last decade and a half how many corrupt activities have penetrated the walls of government.
Before I go to other issues, just talk to us about how they do that accountability and oversight, making sure that it goes where it's supposed to.
Well, I suppose they demand that the Treasury actually shows in its books and shows evidence on a continuing basis. I suppose continuing, every year or every 6 months, World Bank officials would come here and make out and have discussions with Treasury officials to see how the funds have been channeled and whether they've been channeled in the right directions. And that is what is often being resisted by certain more radical elements within the ruling party and opposition parties. They say, we don't want to have the World Bank lending to us because they impose conditions on that lending. But I see it more as an advantage to ensure that we prevent corruption.
Well, that means you would have answered 2 questions from now about the mismanagement, corruption and weak governance. But as you say, they've got their own fail-safes to ensure the money is spent properly. I want to talk about unemployment above 31%. This is the unexpanded rate, not the unexpanded rate, and economic growth stuck below 1.5%. Can this loan really, Azar, realistically catalyze inclusive growth and job creation? Or, are these claims overly optimistic?
Yeah, only to a very limited extent. Let me put the magnitude of this loan into perspective. Total government debt is currently in the order of 5.5 trillion rand. This is 27 billion rand. So it amounts to 0.5% of the total government debt. Now, you're not going to shift the needle massively with an investment of 27 billion. But at least it will start, hopefully, addressing some of the key constraints to higher economic growth, and especially in the field of transport and logistics.
All right. So again, we have what we're seeing globally, right? And there's a lot of changes, global volatility. We've got the rand being vulnerable. The question then is, could currency risks or some of the external shocks make the repayment of this dollar-denominated loan far more costly than Treasury projects? I mean, I think you made a really clear case in the beginning why this is a better route to go. But there's a lot that we can't predict, right, in the market.
Very good question, Iman. The danger with getting foreign loans like this is that the currency bombs out, and then when the time comes to have to repay that loan, or even the interest, you have to pay it in far more rands than would previously have been the case. The advantage of getting a loan like this at this stage is that, at 17 rand 70 to the dollar, the rand is still relatively undervalued compared with where it has been over the last 30 years. Estimates say that if the rand were to be trading at the average purchasing power that it has been trading at for the last 30 years, we would be looking at something more like 14, 15 rand to the dollar. So essentially what that suggests is that borrowing the money right now means that the downside for the currency is relatively limited. We've seen it blow out to 19 rand 90. That's not a huge depreciation in the broader scheme of things compared with 17 rand 70. And the beauty of this situation is that if your currency risk on the downside is fairly limited, then that is the time to actually take out foreign loans, because it means that there is as much, if not a greater risk, that the currency appreciates, and that you can pay back that loan at a later stage with fewer rands than is the case right now.